Today's date is 1st October 2017. The Treasury Department plans to hedge a receipt in Euro dinar of 27 million. So 27 million dinar is the receipt. The receipt is expected on 31st January 2018 and will need to be invested until 30th June 2018. So today is 1st October. And you will receive a receipt on 31st January and you will invest that till 30th June. So when you are expecting to receive the amount on 31st January, okay, as per our prior knowledge, if you are receiving any amount on 31st January, you will select the contract expiring after this date. Okay, after this date, you will select 31st March. Okay, so you are receiving the amount on 31st January. So you will select the March contract. So how many months are there till 31st January? October, November, December, January. So after 4 months, October, November, December, January. After 4 months, and how many months, for how many months you are investing? From 31st January to 30th June. Feb, March, April, May, June. 5 months. 5 months. Okay. You are investing after 4 months for a period of 5 months. Okay. Which contract you will choose? 31st March. Okay. How many months are there from October to March? From October to March. October, November, December, January, Feb, March. How many months? 6 months. Okay. If you receive the amount on 31st January, how many months will be remaining? So total months are 6. Remaining months will be 2. So I will request everyone, the number one task which you have to do in interest rate risk management, clear all these months. Write all these months. Make a timeline, write all these months. What I have done, today is 1st October. Today is 1st October. We will receive the amount on 31st January. I have written 31st January. Okay, we will invest till 30th June. 30th June. So today is 1st October. We will receive the amount 31st January after 4 months. We will invest from 31st January to 30th June for 5 months. Okay, if we choose the 31st March, sir, why? How do you know that you will choose 31st March? Because contracts are available March, June, September, December. And whenever there is a date, we should choose the date of contract after our transaction date. If our transaction date is 31st January, we should choose the March, not the December. So we will choose the March. So how many months from today's date till March? 6. And how many months would be remaining when there is a transaction date? 2 months. Okay. Then central bank base rate in Euro is 4.2. This is current interest rate. Today's interest rate. Current spot. This is current spot. Current spot. Okay. We normally solve in an interest rate shape. Examiner normally solve in this way. Examiner will write this as 95.8. We write normally at 4.2%. It's up to you which approach you want to follow. The Treasury team believes that it can invest funds in Euro at the central bank base rate less 30 basis points. So your final income will be base rate minus 30 basis points. However, the Treasury staff have seen a prediction that the central bank base rate could increase by 1.1%. So 4.2% can increase to 5.3 or fall by up to 0.6. So 4.2 will fall to 3.6% between now and 31st January. For the purpose of this example, we will consider the following possibilities. Number 1 is interest rate future. Number 2 is exchange traded option on interest rate future. So the 3 months future is given 500,000 is the contract size in dirham. 100 minus our interest rates are given. We will choose the March contract. And if you convert this, this will be 5.22%. It's up to you. You want to solve in this way or you want to solve in this way. It's up to you. In both ways, answer will be same. Okay. Exchange traded options are given. Contract size, premium, the true strike prices are given. Call and put option is given. Assume future and option contract are settled at the end of each month. In the first instance, we will follow the approach used in the past exam question and assume there is no basis risk. So we will solve this question like a normal question of any past paper. We will assume that there is no basis risk and the basis diminish at a constant rate. There, I'm assuming there is no basis risk. Basis would be there and basis would diminish to zero, but there would be no basis risk. Based on the monthly interval, we will then introduce basis risk and consider the impact on our recommended hedging strategy. So we will solve it as a normal question. Okay, how to solve this? So although standard solution is given, let me solve it here. Let me solve it here. Number one step. So this is the investment case. 27 million. Okay, 27 million dinar. Okay, we are investing. So whenever you are investing, you will receive the interest. So what you will do? Buy future. Which future? March. At 94.78. 5.78%. Right? Next is okay, number of contracts. 27 million. 0.5 million is the contract size. Okay, number of months of deposit 5 and 3. So what is the number of contracts? 90. Please confirm 90. Okay. Investment done, buy future done, March done, contracts given. So now let's compare it with opening future and calculate gain and loss. You have written opening future 94.78 or 5.78. And now you need closing future. Obviously, you don't have that. You need closing future. So we will solve in the working. Obviously, in the Excel, you can solve it here, but I'm writing it on the paper, kind of a paper. So I have to show the working. Otherwise, on Excel, you can show in the cell. So let me solve it in the working. In exam, you can also show in the working. Closing future. Closing spot plus opening future minus current spot into remaining months divided by total months. So this is the formula. 5.22. This is the formula. Okay, what is the closing spot? Closing spots are 2. In interest rate, there is always, normally 99% chance, there would always be a 2 closing spot. So give the heading here, closing spot, uh, 5.3%, then 3.6%. Remember, we have already calculated 5.3 and 3.6. So let me solve using 5.3%. Okay, opening future 5.22 minus current spot is 4.2%. Remaining months are 2, total months are 6. So please calculate the closing spot. 5.22. Okay, this is 5.64. So let me write the breakup. It would be easy for you. 5.3 plus. So this yellow highlighted is 0.34. So 5.64. Now at the same time, save the time, guys, and solve the working for the other. In other case, this would be same. This would be same, right? Only closing spot is different. 3.6 plus 0.34. So this would be 3.94. Please confirm. Everyone, please confirm. This is right, okay? Okay, perfect. 5.64. Okay, here all the steps are same. $3.94. Now let's calculate gain or loss. You have entered into a contract that you will receive, 5.22. And market has moved to 5.64. So in this case, you are at a gain or loss. Loss. How much? 0.42. And in this case, you are at a gain. How much gain? 1.28. Okay, now last step. Actual actual income or actual lending rate, whatever you want to write. I'm just writing the interest rate. You can convert into the dollar amount, okay? Dinar amount. So now interest rate has moved to 5.3%. Minus 0.3. Remember, minus 0.3. So why minus 0.3? Because this is a lending case. So it would be LIBOR minus spread, KIBOR minus spread, CIBOR minus spread, whatever the base rate minus spread. 5%. Loss. 4.5. 3.6. Effective rate. Right? Okay, guys. Okay. Number one correction. This is 4.58. Okay. If you want to convert this into absolute amount, how to do that? Go to the question, check what is the tick, number of ticks. Number of ticks are not given, but contract size is given. So tick value is amount of contract into 0.01% into 3/12. So it is equal to 12.5. So tick value is 12.5. Okay. Now what to do? Convert this into ticks. Whenever there is an answer, if it is a loss, if it is a gain, divide this answer with 0.01%. So number of ticks are 42. Into tick value, that is 12.5. Into number of contracts, that is 90. So what is the absolute amount, guys? $47,250. Okay. And how to convert this gain? Divide with 0.01%. So it will be 128 ticks into 12.5. What is 12.5 tick value? How can you drive it? You will drive it from the contract size into 90. What is 90? 90 number of contracts. 128 into 12.5 into 90. 144,000. Okay. And how to convert this 5% into absolute amount? This is easy. Loan amount into 5% into 5/12. What is 5/12? Number of contracts, 5/12. Sorry, number of contracts, it's duration. Okay, 27 million into 5%, 5% is the interest rate into 5/12. 5/12 is the duration of the investment. So what is the amount? 27 million into 5% into 5/12. 562,500. Minus 47,250. So it would be minus 47,250. It would be equal to 515,250. And here, if you want to convert 27 million into 3.3% into 5/12. 371,250. 144,000. And that would be equal to 515,250. Please have a look on this, guys. Please have a look. That's all the option contract. So there are two cases. 5.3, 3.6. Okay. So number one step. Investment. 27 million. So we are buying future. Call option. March. Exercise price. So there are two. 94.25, 95.25. $94.25, 95.25. Okay. 94.25 means 5.75. This is 4.75. The contracts are 90 for every, because option size is 500,000, so contract would be 90. Same. Premium. There would be no put option. There would be no June. There would be no December. 0.545, 0.098. 0.545. 0.545. 0.098. 0.098. 0.545. If you want to convert it into absolute amount, this would be 54.5 ticks into 12.5 into 90. 90 is the number of contracts. $61,312. 9.8 into 12.5 into 90. Okay. Now decide to exercise or not. Okay, closing future 5.64, 3.94. Okay, will you exercise or not? Will you receive interest at 5.75 or 5.64? Number one case. Will you exercise? Yes. In this case, no. Yes. Yes. Okay. Am I correct? Please check. Okay. Now you can calculate the gain. Gain is 0.11. Gain is 0.81. Sorry. What is the gain? 5.75 minus 3.94. 1.81. And 0.81. Okay. You can convert it into absolute amount. That is using the same technique. Okay. Now, the actual income. We can copy this from above. We have already calculated actual income. What was that? 5%. In this case, 3.3. What was the premium? 0.545. 0.098. Why I am deducting the premium? Because above two are income. Effective date. 5.11 minus 0.545. 4.565. 5 minus 0.098. 4.902. 3.3 plus 1.81 minus 0.545. Oh, by chance, both are same. 3.3 minus plus 0.81 minus 0.098. Hmm. 5% is the actual income. 5% is the actual income. What is the, we are exploring two cases. When the closing spot is 5.3, when the closing spot is 3.6, right? If the closing spot is 5.3, you can invest interest rate minus 0.3. So it is 5%. Here, when the closing spot is 3.6, you can invest 3.6 minus 0.3. So kitna aa gaya? How much is 3.3, right? Okay. Decide to exercise or not. It is the case of investor, lender. You will receive 5.75 in the option. This is the option exercise price. So you like 5.75 income or 5.64? 5.75. You will exercise. Here, option will give you only 4.75, but market is at 5.64. So you will not exercise. Here, option will give you 5.75, but market has 3.94. So you will exercise. You will not go to market. Okay. Here, option will give you 4.75. Market is giving you 3.94. You will exercise. So please tell me which one is better. Option, which exercise price is better? Which exercise price is better? This one, right? Right? 4.5, which is giving you 4.56% interest. But the future is giving you 4.58. So which one you will choose? Which one you will choose? Obviously, future contract, right? But there is one problem. Problem is, in future contract, there can be a basis risk. Till now, future is better. Future is giving you 4.58, option is giving you 4.56. If everything is according to the prediction, if everything is certain, we will choose the future contract. It is giving you more income. But in future contract, there can be a basis risk. So what is basis risk? You have predicted that closing future is 5.64. You have predicted that closing future can be 3.94. But in reality, future price can be different. So just for the sake of example, if in the rising interest rate, future price turns to be 5.3%. Okay, what was in our prediction? What should be the future rate? हमारी prediction क्या थी? What was our prediction? It should be 5.64. But in reality, it turns out to be 5.3%. So what will happen? Your effective rate will change. So how to solve it? Examiner will give you in the B part that closing future is not what you have predicted. It is different. Okay, no issue. Go to the second last step. Compare the opening future. Opening future was 5.22 with the closing future. Closing future is 5.3%. In our prediction, it was 5.64. But now, according to the examiner, it is 5.3. So loss is 0.08. Okay. Actual income is what is the effective rate? What is the effective rate, guys? 4 point. Okay, I think I have mistakenly took the wrong price. Okay. I have taken the wrong price. Okay, our protection closing future is 5.64. Let me read it. Today, date is 31st January. The prediction that the central bank base rate might increase by 1.1 to 5.3 turns out to be exactly correct. Okay. Based on our previous basis correction, we would have expected today's price for the March contract to fall 94.36. In our prediction, it should be 94.36. That means 5.64. However, actual here it is given. However, future contracts are exposed to basis risk, which means the closing March future price on 31st January could be more or less than the predicted. For the purpose of this example, we will assume that closing future price on January is 94.16. Sorry, I assume that this is it's not 5.3. Closing future is 94.16. 94.16 means 5.84. बात समझ आइए, guys? Are you getting this? We assume that it should be 5.64. But examiner normally it would be given in B part. Normally, if examiner wants to check the basis risk, it would be given in the B part. So according to the examiner, it is equal to 5.84, 94.16. So what you will do? You will solve the second last step again. Opening future 5.22. Closing future, previously we had written 5.64 and calculated loss of 0.42. But now examiner has given us this value, 5.84. So our loss has increased. So what is the loss? .62. Actual income is same. Closing spot, that is still 5.3. In exam, closing spot can be different. 5%. Loss is 0.62. So effective rate is 4.38. By the way, I have explained this in the yesterday video. In interest rate risk management, you have to solve the second last and last step again. In currency risk management, you have to solve the effective rate again. Lock-in rate again. So 4.38. It is different. From our original prediction. What was our original prediction? 4.58%. Why it is different? Because in future contracts, you are facing basis risk. In future contract, you are facing basis risk. Okay. So what to do if there is a basis risk? We should go to the alternative. We should select the alternative derivative, the other derivative which is available, which is here option contract. Okay. So what about the option contract? In option contract, go to this part. Only select the higher interest rate part because it is examiner is asking only about the 5.3% case. Write it here. Instead of writing 5.64, you will write 5.84. Okay. Will you excise? No. Will you excise? No. $4.46%. Okay. Sir, why you have not solved the other part? 3.6% case. That will not change. Because in B part, examiner is only asking about the increase in interest rate. That will remain same. That is 5.65 and 4.01. 5.65 and 4.01. Okay, that would remain same. Okay. So future market provides a lower return than both option contracts, although we have already determined that a risk averse trading manager would have ignored the 95.25 option, the 4.75. However, the 94.25 option now looks more attractive than the future outcome, even though the central bank base rate increase exactly as predicted. So option contract is looking more good here because option is giving 4.45, but the future is giving 4.38%. If the relationship between future and the spot price is not predictable, there is no guarantee that the closing future price on 31st January will match the price predicted by our basis calculation. So on October, the future price prediction was 5.64. This was 5.64. Assuming the base rate increased to 5.3, but it could be either more or less even when the base rate increases exactly as predicted. So guys, in simple words, the closing future which you have predicted, that is not guaranteed. It can be higher, it can be lower, because in future contract, you may face the basis risk. So there is a problem with the future contract. You can face the basis risk. So what to do? So in that case, you can write the problem of the future contract and you can recommend the other derivatives. Okay, this is a discussion. Okay, the exposure to basis risk means that actual future price fell to 94.16, 5.84. Instead of 5.64, an unexpected change in basis even marginally reduces the return on the future contract from 4.58 to 4.38, as opposed to the return of 4.45 using the option, with the benefit of insight that 94.25 option would have provided a better outcome. However, the Treasury Department last thing. However, the Treasury Department have limited visibility of the future when choosing an optimal strategy at the time the hedge is set up. The Treasury Department best estimate of the closing future price is based on the simplifying assumption that basis diminishes to zero. Therefore, introduce an element of unpredictability which the Treasury staff need to be aware of the outset. Scenario analysis would be useful in determining the final strategy in accordance with the company risk preference. So let me summarize it. In exam, there can be a part A where you will assume no basis. Then part B, where examiner will give you closing future. You will calculate effective rate again and identify basis risk. Okay. And discuss the case. Discussion is very simple. Future always have basis risk. Whatever closing future you will predict, that is under the assumption that there is no basis. But, however, in reality, there would be basis risk. And your effective rate will be different. Okay, you have to incorporate this point in your discussion. And then you will assume, then you will write that we should do the scenario analysis whenever we are going to select the future contract. Although option contract gain is not looking attractive, but the option contract, you have the option to lapse if the market becomes favorable. If market becomes unfavorable, you can enjoy the option contract. So that's how it will be tested in exam.